One of the reasons I like coming to an event like this is because it serves as a reminder. No matter how chaotic things get in financial markets, you still have a business to run. The show must go on.
Yeah.
What is going on here, and why is it important to Morgan Stanley?
Yeah, this is phenomenal. This is something we started a couple of years ago, and the idea was to create a lab, a workspace, for a bunch of venture startup firms, organizations, women-owned, and people of color-owned. And with this second year, we bring them here, and today is basically showcasing what they've produced. We've had over 100 investors come through, tremendous interaction, and I'm just so proud of the team led by Carla Harris who put this together.
James, would you call this impact investing?
No, I think it's broader than that. I think it's about creating opportunities. I mean, the stats are staggering. Of all the venture money that is raised and is managed for companies that have been built by women-only organizations, women-led organizations, only 2%. So 98% of the money is not going to that segment. Less than half of 1% to people of color. So we're trying to create an opportunity to bring the investors the money to where the talent is, and we've got tremendous talent here.
And you're putting some Morgan Stanley balance sheet to work here as well.
Well, we put a little equity into each of these. I mean, it's $200,000 per organization. We're not trying to dominate it. We just want to give them a little capital to get going, a little working capital, if you will. But the most important thing is we give them the space to work here over several months. We give them all the firm's resources. We give them the networking, and we give them training and mentoring. Then we bring the investors to them.
Do you expect to make money, or is it okay if you don't?
No, listen, I expect these businesses to make money, so as owners, absolutely. I mean, we want them to be successful. They are, today we just sent out the application efforts for next year. They're way oversubscribed, so it's very difficult to get in. No, we expect them to be successful. With that, of course, we will be.
Let's talk about what's happening outside this building right as we speak. These are challenging times for your clients.
Yeah.
How challenging are they for Morgan Stanley?
You know, from what we've been through, Eric, I mean, not to be dismissive, but
this is not 2012.
Well, it's not 2008. It's not the dot-com bubble burst of 2000. It's not when I first came to the U.S. I was coming out of graduate school in 1987. I mean, listen, this is a market correction that we're going through right now. I'm sure we'll talk about in detail. But no, this is well within our wheelhouse of what we can handle.
Is it a healthy shakeout, this correction, this contraction of multiples in the broader market and what we've seen happen to tech stocks in the last few days?
Well, I think if you step back from it, what's going on? Firstly, we're in a tightening process around the world, led by the U.S. 3 and probably 4 rate increases this year. That has consequences. The ability of the monetary authorities, given their shrinking balance sheets, also has limitations of what they can do. And we've got a lot of political turmoil. So it's not surprising the markets have been anxious. It's not surprising you're seeing some correction. Against that backdrop, within certain sectors, the FANG stocks, incredible run-up in valuation this year. Hundreds of billions of dollars of value created in some of these companies this year. It's not surprising some of that's been taken off the table.
Well, there is a lot of debate, and I guess the debate is reflected in the volatility that we see over a number of the things that you just itemized.
Sure.
The sustainability of U.S. growth, for example, the pace of rate increases, and the magnitude of rate increases, the implications of this standoff that the administration is undertaking with China, for example. Is there any consistency around that debate as far as what you hear from clients?
Well, I think that the most important thing to take away is there's just a lot going on. I mean, you think about it. Every morning you get up right now, and there's a strong news flow from overnight. Brexit, tariffs, political risk, protectionism, anti-immigration, all of the...
You're right, it's a much longer list.
Before we get to the markets, right, before you get to China, before you get what's going on in the Middle East, before you get to the sanctions in Russia, before you get to the war in Syria, before you get to North Korea and are they still testing or not testing, it is a lot for investors to absorb. When investors are confronted with that against the backdrop of, on the one hand, very strong economic fundamentals, on the other hand, tightening and clearly some corporate credit, let's just say, the corporate credit boat is full, right? So clearly issues around BBB credit. So you've got this combination. It's not surprising the markets are anxious. This is what markets do when they deal with uncertainty. They get anxious. In the short term, sometimes they get it very, very wrong. In the long term, the market always is right.
There's so many directions I could go right now. I'm going to go in this direction.
Well, we're on for 2 hours, right, Erik? So it's okay. I'm all good.
Is the volatility in financial markets good for Morgan Stanley's trading business?
Honestly, I care more about how it affects our clients, because if our clients do well, then we do well. Yeah, I mean, listen, in the equities markets right now, some of the volatility is good. It's not great. Think about it. The ECM calendar, the equity capital markets new issue, that's been pushed back. More uncertainty around M&A transactions, but more transaction, more volume in cash, equity derivatives, so that's been positive. Across.
So you're seeing more trading and perhaps even bigger trades by some of your clients?
No, not necessarily bigger trades, but you're seeing some more volatility, and with that more activity. On the other hand, you're seeing the calendar being pushed back. So it's gives and takes.
Yes.
On the other hand, start looking at the fixed income space. And, these are more difficult markets for the credit shops and fixed income. So it's not clean. None of us, we don't wake up every morning and say, gee, we hope the market's really volatile and investors are anxious. This is not our objective. We look at the fundamentals and we try and make sure that our clients are well positioned for whatever risk profile they've got.
Do you share the view, James, that there's a bubble waiting to burst in corporate credit?
I think we've got, $2 trillion total exposure in BBB. You're going to have some issues. This is a consequence of a very long bull market coupled with inevitable tightening towards the end of it. Do I think it's a bubble? I don't know if I'd call it a bubble, but it's certainly a factor. If you look at where the issues are in the market, that's certainly one of the factors.
When you say issues, people wonder themselves, how are those issues going to get themselves worked out? Are they going to be worked out in the way markets can occasionally work things out relatively smoothly, or are they going to be worked out in a disorderly fashion that some people might want to call, perhaps in the moment when it comes, a crisis? Yeah,
well, listen, I would step back and say, against the backdrop of these issues, what do we know that it's positive? U.S. economy is growing over 3%. Okay, unemployment, we've got a 3 handle on unemployment. That's extraordinary. We have economic growth in China, in Japan, in Southeast Asia, in Europe still. Across almost every part of the globe, you've got economic growth. So add that basic economic growth and stability to the political risk and anxiety out there, and that's where you're starting to see some of the conflict in a period, as I said earlier, where we're tightening.
What kind of economic scenario are you baking into the firm's strategy for the next 12, 24 months?
Well, we're in the middle of our budgeting process right now. I certainly don't expect growth above the 3.5% we're at now. I think it will moderate. I think the stimulus that came from the tax cut was effective, but that level of growth is unlikely to be supported. I'd say, I'm personally am looking at sort of the 2.5 range and where I think GDP growth for the U.S. is going to be.
Is it axiomatic that Morgan Stanley can't do as well in a decelerating economy as it has done in an accelerating economy?
You have to look at all the mix of our businesses. Some of the businesses do better in a decelerating economy, but at the backdrop, what I care about is I'm really not that focused on the market turmoil now. What I'm focused is the long-term strategic positioning of this firm. And we are strategically, I think, in a great place for the next decade of growth. I'm less focused on what's going on right now.
Well, you entered, I know, because we talked about it, you entered 2018 with at least a couple of strategic priorities, among them getting significantly bigger as a bank, and the other was to expand in asset management. What are the next steps required to fulfill those priorities?
Yeah, listen, in asset management, we did our first acquisition in 10 years, Mesa West, California real estate credit shop. Gone really well, great integration. And we're looking at a series of those kinds of smaller bolt-ons to fill out some products and services. In the bank, it's pretty simple. We manage about $150 billion of deposits for our clients. We have a huge mortgage lending book, high quality, large jumbo mortgages, and we just see more opportunity. Our clients do a lot of banking services away from us. We're bringing those banking services to Morgan Stanley.
when you talk about potential acquisitions in asset management, they're going to continue to be small because some people at the firm think there's good reason to explore larger deals, and some of the larger asset managers are trading at low multiples relative to where they've been historically.
True.
Even lower than yours.
Yeah.
So, in theory, there might even be accretive deals.
Well, we look at all possibilities, Eric. You know, strategically, what we've tried to do is position the firm where the annuitized revenue, fee-based revenue of the firm is about half of what we do. We're very close to that. But listen, if you have the industrial logic around what your strategy is, then as doors open, you take advantage of it. So I'm not saying no, but right now, our focus is on continuing to grow in the core businesses we are, and where we see opportunities from acquisitions, obviously we look at them.
You have become a larger bank, got $200 billion in bank assets. You've become a larger commercial lender. One of the companies you've committed credit to is GE. GE's been in a bit of trouble lately. Could GE become problematic for Morgan Stanley?
No, and listen, I think, firstly, Larry Culper's doing a great job. He's been thrown into an incredibly tumultuous situation. I have a lot of empathy. I've walked a few miles in those shoes myself. I mean, it reminded me as I was reading about some of the stuff of what we went through 10 years ago. The market over-worries. GE is a fantastic institution. They've got tremendous ability to restructure the assets there. Sell off pieces of the business. They're in the process of doing that. No, I'm not concerned about GE's credit at all. I think it's a world-class company. They're going through a tough time, and they've got a great leader who's doing something about it.
So even if they do end up drawing down the credit facility, you're confident it's money good?
Absolutely. This is GE. Absolutely. This is one of the great institutions in the world.
James, anecdotally, it seems like competition for talent, specifically in investment banking and specifically in tech and data, is as intense as it has ever been. Is that the case?
You're talking about tech banking?
Well, no, technology capabilities and data science capabilities and some of the things that you're trying to incorporate.
Yeah, you look at the fastest growing sectors in the economy and within the services economy, it's exactly those. I mean, it's programmers, it's mathematicians, it's engineers, it's people who have data skills, people with expertise in cloud computing and robotics and machine learning, AI, all of the stuff that we read and talk about before you get to the Bitcoins and the blockchains and so on. It's a war for talent on the tech side.
Is it getting harder as a result to enforce discipline on cost?
No, in that space, listen, there's wage inflation in the tech space, I'll give you that. But, you know, we're being, if you look at our expense ratio, we had a target this year to be below 73%. I think we're running about 71% year to date. So not at a level where it's affecting us.
It's affecting
it might be different for a pure tech company, but not a level where it's affecting us.
James, I guess I would say that it's conventional wisdom that what's bad for Goldman Sachs is good for Morgan Stanley. Is that the case with 1MDB?
I'm not going to comment on that. You wouldn't want me to or expect me to, I'm sure. By the way, I don't think that conventional wisdom is true. I think we work in the same industry. We do a lot of things. We're often on the same side in a lot of transactions. I have great relationships with the leadership at Goldman. I have great friendship with Lloyd. They're a tremendous institution, and we've all had our challenges, and I'll let them work through that one. I'm not going to answer that.
Well, I will say this. He told me recently that during one of the periods in which Goldman was confronting controversy, let's just say, in the post-crisis period, you were asked about that, and you said something to the effect of, "There, but for the grace of God, go I." And he's remembered that. Do you feel the same way here? It's sort of, when one firm encounters trouble, it's the kind of thing that could, at any day of the week,
listen,
confront you as well?
There were things we did during the crisis, before crisis, and so on, leading up to it, that I wouldn't expect another firm to have done that. I don't think these things are interchangeable. I think you've got to look at every situation differently. All I'm saying is the corporations in this country need strong, independent investment banking businesses. I have a lot of respect for our competitors, and they've got to work through their own issues.
If you had to say one thing that is going to, I know you put together these goals and priorities, these three different lists that you work from as you head into 2019, what's new at the top of strategic priorities?
Well, I can't tell you because it's got to be early January, but I'll give you some indication of what might be new. Clearly a focus on asset management is critical for us. We're doing a big review of our Asia strategy right now, in both China and non-China Asia. Our partnership with MUFG, I think, is reaching a new level. So there's a lot of stuff going on. But if I could summarize it in one word, growth. We're focused on long-term growth.